When we look at the economy, there's been a global obsession this year with the word recession. When's the next recession going to happen? How deep will it be? How long will it be? What we do know, and what we've stated in our prior quarterly, is that we're already in the technical definition of a recession. We've seen 2 consecutive quarters of negative GDP. So regardless of when the National Bureau of Economic Research eventually comes out and dates the start of this recession, whether it's this calendar year or next calendar year, it's important to understand that investors and consumers already feel like we're in a recession. When you look at this chart, consumer confidence is hovering near record lows. You can look at the gray shaded areas. These are past recessions. You can see that consumer confidence is lower than we've seen in many of the last recessions. The biggest risk to the outlook for growth continues to be the Federal Reserve and interest rates, and we don't see that the Fed is going to stop aggressively raising rates anytime soon. When you look at this chart, it shows you that the path for the Fed funds rate will be to hike it and to levels we haven't seen since the Great Recession. And the result of that, we think, will ultimately be a slowdown from not only the consumer side, but also the business side. We have seen that consumers have been relatively resilient this year, but we don't see, with interest rates rising the way that they are, with confidence as low as it is, with the savings rate as low as it is, that consumers will be able to sustain this type of spending. We've already seen them pull back on some discretionary items like furniture and electronics. Eventually, we think this can also weigh on business spending. Those are things that can have an impact on GDP. Now, let's be clear. We don't think that we're headed for a 2007 to 2009 type of recession where you had a housing collapse, you had you had the banking market collapse, you had consumers collapse, and you had a major credit crunch. We don't see that type of recession. Instead, we actually see a path for a healthy contraction in economic growth, especially after we've seen such an unsustainable surge after the pandemic. And there's several reasons for that. We've noted that consumer confidence is very weak, but coming into this economic downturn, the balance sheets for consumers, their debt service ratios were very low. They took advantage of the very, very accommodative monetary policy over the past decade. The labor market undoubtedly is going to slow down as economic growth slows down. But we kind of need that. Right now, we still have more than one job posting out there for every unemployed American. And what you can see in this chart is that the labor force participation rate has not come back to pandemic levels yet. So there is room that Americans can come back to the labor force if they need to sustain their lifestyles. And then lastly, inflation is a big risk. We realize that. But we are starting to see some very beginning signs that inflation may start to slow down. We're not going to get back to that 1% to 2% inflation that we've been accustomed to, but we don't think the levels of inflation right now are sustainable. These things should help from an economic standpoint for us to have the healthy correction and move forward into the next phase of an economic expansion.